As we all know, the coronavirus is front and center on everyone's minds and could have material impact on economies and markets in the short term. Arguably, though, when major turmoil comes up, it's even more important for investors to be grounded and to get clear on what's important in the long run. I had a chance to sit down with the Chief Investment Officer of TD Asset Management earlier to discuss the state of the longest-running economic expansion and what it means for stocks, bonds, and alternative investments. I want to start, if I could, by grounding the conversation that at present you are constructive on equities, you are constructive on alternatives, and worth mentioning, we are in the longest expansionary economic cycle we've seen, period. So tell me a bit why, in terms of, we'll get into the specifics on what you like and what you don't, but tell me just about the economic cycle. What are you seeing right now?
Yeah, in terms of the cycle right now, what we're seeing is probably, or what we're coming through, is probably the third kind of mini pullback within a very long cycle, as you'd mentioned. So we're a little bit more positive with respect to the potential for economic growth. I don't think we're out of the woods yet, but we're seeing, you could call it green shoots, people call it green shoots. If you look at OECD leading economic indicators, they've picked up in the last couple of months, and that's really based upon what we've seen in terms of interest rate cuts by central banks. And so we've seen 71 cuts by 49 central banks over the last year, over 50 basis points of interest rate cuts. And we think that helps to bolster and return us to a better path of economic growth. But that's not without risks. I think the concern about recession has faded somewhat. But if you look at the IMF, for example, they came out the other day and they did cut their global forecast for 2020 and 2021 modestly from 3.4 to 3.3% in 2020 and 3.6 to 3.4% in 2021. And I think we're seeing the tail end of those negative revisions to economic growth. And we're seeing, again, some signs of pickup. So that does make us a little bit more optimistic.
It's interesting, too. You wrote in your note, this is what came up from the Wealth Asset Allocation Committee, that the one thing about this cycle overall, too, is it seems as though the growth is a bit shallower. So we're not seeing perhaps the excesses that we've seen in other growth cycles, which I think, is maybe adds a bit to the optimism.
Right. Yeah, to this point, we've not seen a lot of excesses. We certainly haven't seen it on the inflation side. While employment has been very, very strong in the U.S., employment has been quite strong in Canada. We've seen some wage inflation recently, but to a degree that's been mitigated. Again, inflation is not a concern. We've seen inflation stats pull back a little bit in the last couple of reports. You look across the board, the commodities, we're really not seeing any inflation as well. Across the commodity metals, copper, aluminum, zinc, nickel, really no pressure on inflation. So again, we're not seeing a lot of the excesses that perhaps we've seen in other cycles.
You highlight, though, that it's not without risk. I mean, there are things happening right now, and I think there's a great quote in here as well. It talks about expansionary cycles don't end without a reason. What are the risks that you see out there right now?
I mean, certainly trade is a risk, and while we have seen a phase one deal in China with the U.S., it covers a small component of the tariffs. So it covers roughly 10% of the tariffs that have been implemented. So there's a lot of concern that we don't get to the next phase in a trade deal, and that perhaps it doesn't hold. And again, that's concern about global trade could be enough to derail economic growth. It certainly has had an impact and a drag on global economic growth to this point, and it's certainly not over in terms of what that story is to this point.
In terms of politics, I mean, is that something? I mean, we see headlines of impeachment hearings going on and everything that's happening. When does the market start to care? Because I think that's one of the most fascinating things right now is that market is not an issue.
Yeah, I mean, you talk a lot about noise in the market, and that may be more noise than substance at this point. So I think you'll see a lot of noise, but in terms of how that impacts economic growth, probably not a lot to see there. How it impacts sentiment, though, is a little bit different. And you could see volatility associated with that, but I don't think it takes us off the path that we're on with respect to economic growth or the direction of interest rates or equities.
Right now, the Wealth Asset Allocation Committee is looking at, the equities, alts, fixed income, and we'll talk a little bit about currency as well. But in terms of equities, overweight equities right now. Give me a bit of just the thesis behind that. Why?
Yeah, I would say kind of a modest risk position at this point. So we have a modest overweight in equities relative to a sort of a neutral position. Underweight fixed income. And in terms of equities, what we're looking at is probably in rank order, the U.S. followed by Canada and then international. And in terms of the U.S., while valuations are high, earnings growth has continued to or is resuming its stronger path. And so earnings growth in the U.S. in 2020 could be as high as 9%. And so that's a strong number. And again, valuations are somewhat higher. If you look at Canada, we've certainly got lower economic growth, lower earnings relative to that in the U.S., though we could see a bit of a pickup in economic growth and earnings in the latter half of 2020, but we're certainly not seeing a lot of signs of that yet. Internationally, we're seeing some pickup in economic growth, which we think will lead to earnings. So we're getting a little bit more optimistic there. Valuations of Canada and the U.S., or Canada and international markets are still in good shape.
Mm-hmm.
But again, what we're looking for is that pickup in earnings growth to support those valuations.
If we take a look at the next class here, alternatives, and it's nice to be able to talk about this because it's the first time we have in terms of the Wealth Asset Allocation Committee. You have a modest overweight in the alt space right now. Tell me a bit about just the reasoning behind that. I know obviously alt's made up of different categories we'll talk about, but why modest overweight? Yeah,
and again, alternatives for us are real assets. It is really a diversifying part of portfolios for our clients. We're still seeing attractive opportunities and diversified opportunities in those areas. If you look at real estate, for example, you continue to see reasonable yields in real estate. So net operating income yield in real estate in the 4.2, 4.3% area. But importantly, you're seeing a growth in that income. So net operating income growth is for our portfolios probably in the 3.2, 3.3% area. So again, those are pretty good growth numbers relative to what we're seeing in terms of inflation. And so again, inflation is not a huge concern at this point. Is inflation dead? I'm not sure about that. But real estate, real assets are and continue to be an inflation hedge for portfolios.
And when you look at just, again, because this is the first time we've really had a chance to delve into this, but when you look at some of the real estate strategies, I mean, you have different, obviously, strategies you look at in terms of the kinds of real estate you're involved in terms of core and value add and opportunistic. Can you tell us a little bit about just the kind of, I'd say, specific demographic, economic trends that make certain kinds of real estate more attractive than others?
Yeah, certainly transit link is urban transit link is a big theme in our portfolios. We also look for core, but with an ability to add value, and so or to have a growth component to it. We've recently done a deal with Cadillac Fairview for a mall in Laval. And again, the attractiveness for us is not just the operator. Cadillac Fairview very well respected in our industry, but good yield to that portfolio, but a lot of or considerable amount of excess density to be able to develop that for future growth. And so again, those are the types of opportunities that we look for in that area. Again, to really try to add value to that asset class.
In terms of real estate, you also on the real space, in commercial mortgages and global infrastructure. What are you seeing in mortgages and infrastructure right now that is interesting for the upcoming year?
Yeah, in terms of mortgages, what we're seeing is some pretty good yield advantage. So we're writing first mortgages at 160 basis points over government of Canada. So that's a pretty strong yield.
Yeah.
And again, really relative to what we're seeing in corporate yields. Mm-hmm. So again, we haven't seen quite the spread compression in mortgages that we perhaps have seen in the corporate bond area. So, in aggregate, the portfolio is generating over 200 basis points of spread relative to government of Canada's. And again, in this yield environment, that's quite attractive. In infrastructure, we're still looking for reasonable returns there. Again, we've seen in all asset classes, valuations are higher.
Yeah.
So we've seen rates of returns get bid down. Returns in the 8-9% area for infrastructure in the risk area that we invest in are pretty reasonable expected returns for 2020.
Let's talk a bit about fixed income. You just talked about the yield compression that you're seeing in some of the corporate bond markets as an example. And right now, I believe you are underweight on fixed income. There's variations within the classes within, but tell me what you're seeing there.
Yeah, I mean, we're underweight fixed income. I guess the surprise last year was the degree that we did see the bond market perform and the amount of asset flow into the bond market given how low rates were. But a lot of the concern last year was whether there would be a recession or not. And so that drove rates down, drove the returns in the bond market. But again, relative to what we see on a better pathway to growth in 2020, rates are less attractive, and we've certainly seen spreads compress really all across the board from investment grade credit to high yield credit as well. Spreads have compressed. We see that they're attractive, but not as attractive as they were earlier in this cycle. What
would you say you think right now is the biggest risk for people in terms of these markets?
I would say not being invested in the markets. Trying to time the markets would be one of the biggest risks that we would see. We tend to advocate being fully invested in terms of a diversified portfolio over a long period of time. And again, that's what ultimately allows you to achieve your goals. So timing the market is a bit of a concern. And again, given what happened in 2019. A lot of money on the sidelines in cash, selling off based on what happened in the late part of 2018, and again, not getting back into to the equity market. So, timing is a concern, and so we did have certainly on the retail side a lot of money in bonds and short term. And missing some of that equity rally. But again, our view is don't time the markets, but be in fully invested in well-diversified portfolios.
Rob, thanks very much.
Thank you.